Well, welcome everyone. I think we're going to get started. My name is Ben Lindblad. I'm a partner here in the tax group in Minneapolis. To my left is Nathan Honson, who's also a partner in our tax group here in Minneapolis. Next to him is John Hollinrake from our Seattle office. He's a tax partner there. And last but not least, down on the end, Mike Voves is a partner here in Minneapolis in our benefits and compensation group. Thank you all for joining us today. We have a lot of material to go through. We're going to do our best to keep this to 90 minutes and in fact a little bit less so that we have time to address questions at the end of the presentation. There are sign-in sheets for those of you that are here in person on the table. Please sign in. Please also hold questions to the end of the presentation. As I said, we'll try to save some time at the end. If we do run out, we're happy to stay afterwards to address any questions that you might have. For those that are attending via the webinar, you may submit questions to DorseyU@dorsey.com, and we will answer those questions later on today. So we are here today to talk about Public Law number 11597, which is commonly known as the Tax Cuts and Jobs Act. We say commonly known because just prior to passage, the Senate parliamentarian ruled that the short title of the act was inconsistent with Senate rules and struck it from the act, which leaves us with a law with no name. We're going to continue to call it the Tax Cuts and Jobs Act, as most everyone else has. The law was signed on December 22nd of last year, which gave folks about a week to do some last-minute tax planning. And we are going to see what the fruits of that planning are as we move on here into 2018. Our first session was on individual tax changes. That was back on February 6th. I hope some of you were able to join us for that. Today, we're going to talk about the business level impacts of the act. I'm going to talk a little bit about the corporate tax rate cut and some changes to the business deductions that resulted from the act. Nathan is going to talk about some of the economic and budget impacts that are likely to occur. I'm going to go into a lot more detail in this session about the new Section 199A deduction, also known as the pass-through deduction. And we're also going to talk about some choice of entity and structuring considerations that result from the changes in the Act. Mike is going to talk about executive comp changes as a result of the Act, and then John is going to walk through what are extensive changes to the U.S. international tax regime that are likely to have a very significant impact on the way, in particular, multinational corporations plan for their U.S. taxes. So the biggest change that was brought about by the Act was the reduction of the corporate tax rate to a flat 21%. There are no longer brackets. There's no longer a special rate for personal service corporations. We have a flat 21% rate, and unlike the bulk of the individual changes that we discussed in the last session, this 21% rate is permanent. There is no sunset, there is no phase out of the rate. The corporate AMT was also eliminated for 2018 and years afterward. This reduced corporate rate, as Nathan is going to talk about in a little bit, is going to have some significant effects on choice of entity and investment structuring decisions, because we now, for the first time in a long time, have a pretty significant delta between the corporate rate and the rate that's available to individuals and other taxpayers. The effect of the rate change is clear when compared to other OECD countries. We went from the highest tax rate among that group to the 13th highest as a result of this rate change. Again, this is going to significantly affect the way that multinational corporations think about selecting sites for investment, capital improvement, new factories. In fact, a representative of Intel recently said on a tax panel that this change takes off the table tax as a factor in selecting the U.S. as a site for investment as a result of both the rate change and the changes to the international tax regime that John is going to talk about in a little bit. Along with the rate change, there are a number of changes to business deductions that I'm going to walk through pretty quickly. These are, for the most part, mechanical, but the high-level items are worth knowing about because it affects planning for businesses. First, the dividends received deduction. Under existing law, corporations that receive dividends from other taxable corporations are entitled to a deduction, the percentage of which or the amount of which ramps up as ownership in the underlying corporation ramps up. In order to maintain the effective tax rate that is applicable to these dividends, the percentage had to be shifted down. So for 70% dividends received deduction, that's the deduction that corporations are entitled to if they own less than 20% of another corporation. That was ratcheted down to 50% to retain a 10.5% effective rate. The 80% dividends received deduction, which applies for corporations that are between 20 and 80% owned, was ratcheted down to 65% to maintain a 7% effective tax rate. The 100% dividend received deduction for more than 80% owned corporations remains intact. Another significant change is to net operating losses. For losses arising in 2018 or after, NOLs are limited to 80% of taxable income instead of the previous 100%. It also eliminated the ability to carry back net operating losses for losses that are created in 2018 or after, and extended the carry forward period indefinitely. This had an immediate impact on M&A transactions at the end of last year for a couple of reasons, the most significant of which is because 2017 NOLs were still subject to a carryback, 2018 losses were not. There was a lot of interest in generating as many deductions as possible at the end of 2017, so that to the extent you did create an NOL, you could carry that back against income from previous years, generate a tax deduction. It's also to be seen how this is going to affect negotiations over M&A transactions going forward, because in the past, sellers have generally been able to generate an NOL, carry it back to the extent they had profitable years for past years, and create an income tax refund. Now, that carryback is not possible, and so it increases the likelihood that sellers and buyers are going to negotiate over net operating losses and whether the buyer should pay for those net operating losses in deals. A couple of other deductions that are worth mentioning. There's a new section 163J deduction that replaces the old interest stripping rules. Under this new deduction, business interest for any year is generally limited to 30% of adjusted taxable income, which in the near term is basically EBITDA. It replaces the rules that were in place previously, but to the extent that your interest is limited under the new 163J rule, you can carry forward those limits into future years. The limitations apply to both corporations and partnerships. The rules get very complicated when you attempt to apply them to partnerships. One item to note is that businesses with less than $15 million of gross receipts are exempt from the new limitation. Bonus depreciation. Under prior law, a bonus depreciation deduction was available for qualified property equal to 50% of the basis of the property. Qualified property is generally tangible property with a recovery period of 20 years or less. Under the new law, that's ratcheted up to 100% for property put in place between September 27th of last year and January 1st of 2023, which means immediate expensing for this sort of property. The new act will ratchet down that 100% bonus depreciation for years between 2024 and 2026. It also expands the definition of qualified property to include used property, which may be a boon for M&A buyers as they acquire assets in deals, because it's no longer required that you are the initial buyer of the relevant property. Finally, just a quick note on Section 179 expensing. There were some changes made to increase the amount that you can expense under 179 and also increasing the phase out that's applicable to that provision. Nathan?
I'm kind of skating on thin ice here because we're not economists and these are not our predictions, but we wanted to talk a little bit about the predictions that economists are making about the effect of the new act on the law. I'm particularly skeptical of economic predictions that predict the isolated action of a new law, given that there are so many other factors that are going to simultaneously be affecting the economy. But to try to shoot down the middle of the road, we're going to look a little bit at the predictions that the Joint Committee on Taxation, which is a nonpartisan committee of Congress, has made. And they predict just short of a $1.5 trillion loss in tax revenue over the baseline of the prior act over the next 10 years. That is partially offset by, they've done another analysis that the $1.45 trillion is just looking at the effect of the act itself. They've gone on and done a further macroeconomic analysis where they consider other offsetting factors. The main one of which is that they project that GDP growth will on average be about 70 basis points higher annually than it would have been under the old act. They also project that we're in a climate of rising interest rates and that the loss in federal revenue is likely to also increase federal debt, and so that interest is going to become the federal government is going to be paying a lot more interest. When they offset that all together and net it out, they get to a prediction of about a $1.07 trillion revenue loss over a 10-year period. That's split out, if you can see these numbers, between the changes to the individual income tax provisions amount to about 1.1 trillion of that number. The changes to the business tax provisions amount to about 654 billion of the number, and then the changes, the international tax changes that John is going to talk about, account for a $324 billion increase in federal revenue to net out to that 1.45 trillion. This chart shows the netting. The dark blue bars are showing the loss in federal revenue just because of the act, with the light blue bars showing the mitigating effects of other macroeconomic factors. And a couple of things we can say that all of this economists don't agree on. This is probably a middle of the road position, but there are a couple of things we can say that they do seem to agree on. Number one, the interest is going to be a big deal, both because we know that the Fed has been raising interest rates this year. They've indicated that they'll probably have 3 more increases before the end of the year, and the act is almost certain to increase the federal debt. So there's going to be, interest is going to be a more significant federal budget line item on a going forward basis. The second thing that I think there's general agreement on is that the effects of the act will be front loaded. We'll see most of them from 2018 to 2020. And after that, depending on who you read, it may be tapered off, or the effects in the economy may really not be much at all. The act is definitely a tax cut. It's expected to reduce taxes for the 500 largest U.S. companies by between 75 and 100 billion in 2018. There's been several different analyses done of effective tax rates for public companies. And what those have shown is that on average, and this is definitely an average, there's no question that there are very large companies paying very high effective tax rates and small companies that are paying low effective tax rates. But on average, the effective tax rates for small cap companies, which are represented by the Russell 2000 in the slide, is around 32%, where for companies in the S&P 500, which are all large caps, would be a lower rate. The effect of this is that economists expect that the tax changes will have a greater beneficial effect for small caps than they will for large caps. But in terms of what that does to the market, there's quite a lot of debate over whether the tax changes were effectively priced into the market for small caps before the law even went into effect. What economists are saying that is maybe the most significant question in how all of this affects the economy is what companies will do with the extra money that they have from the tax cuts and from the repatriation of funds that John will talk about. If they spend the money on paying their employees more and on capital expenditures in plant and equipment and the like, or paying it out to dividends to shareholders, all of those things are going to be GDP enhancing because they're going to move money into the economy. If they, on the other hand, are spending money on stock buybacks or reducing their own debt or M&A activity, it's less likely to have a positive effect on GDP. No one really knows where the split is going to be because between those things, but what that split is going to be significant in how the Tax Act winds up affecting the economy.
So now we're going to go into some depth on the brand new deduction that was introduced by the Act that we talked about in a little bit in the previous session, but now we're going to go into with some examples. Before walking through the mechanics and the issues related to the deduction, though, I wanted to address some common misconceptions that we have heard in the first couple of months of this deduction's existence. The first is that the Section 199A deduction only applies to income from partnerships and S corporations. That is not the case. Any non-corporate taxpayer that receives business income is entitled to the deduction. That includes if you're a sole proprietor or an independent contractor. It includes if you hold a single member LLC. It's not required that the income be allocated from an S corporation or a partnership. We've also heard Section 199A deduction is not available to taxpayers in service businesses. It is. It's just subject to much more severe limitations, including a total phase-out over $415,000 of taxable income if you're a joint filer. Finally, there's been concern that there's no value of the Section 199A deduction to high-income taxpayers. High-income taxpayers, if they are in non-service businesses and either able to create or already have significant W-2 wages in their business or significant depreciable property in their business, may very well be subject to the same limitations as lower income taxpayers. There are planning opportunities there that folks are likely to try to take advantage of. So is Section 199A a dream come true? No, there's a number of problems. The most significant of which is that there's an absence of a policy justification for the deduction and its limitations. The stated policy goal was to align the rate that's applicable to pass-through businesses with the lower corporate rate. As Nathan will talk about a little bit in the structuring discussion, it's not entirely clear whether that's a desired effect or a needed effect, but I think more importantly, the deduction and its limitations draw what are very formalistic distinctions between some groups and others that don't have any real clear policy reason. It means that there are some groups and businesses that are going to benefit from this deduction and others that won't, and that taxpayers are going to play games with those lines. The clear winners in the deduction are real estate firms, firms with capital-intensive businesses. The losers are high-income service professionals, high-income doctors and lawyers. Boo-hoo. What's murky is some of the in-between. It's, for instance, architects and engineers were eliminated from the definition of specified service business, but there's some concern that they might be pulled back in because of a catch-all in that definition that I'll talk about in just a little bit. So, how does the deduction work? It's 20% of qualified business income available to non-corporate taxpayers. That's basically individuals, trusts, and estates. Qualified business income is basically what you would think of as ordinary income from the business, less ordinary deductions. It does not include wages. It does not include guaranteed payments or capital gains or interest or dividends, the sort of passive income that you would not expect to be treated as ordinary income. Also excludes any income that's not effectively connected with the U.S. trade or business. Although the Act meaningfully lowers the top rate for qualified non-corporate businesses to 29.6%, it still remains well above the new corporate rate of 21%, whereas under the previous law, we had a difference of 39.6 versus 35%. So there may be incentives for certain businesses still, even with the pass-through rate, to function in corporate form, but none of that takes into account that if you're a corporation and you're making distributions, you're subject to 2 levels of tax. And so there may be planning opportunities, but it depends entirely on the nature of your business and, in particular, whether you're going to extract cash from that business. The deduction is subject to 3 limitations that we'll walk through, including with examples. The first limitation applies to everyone with one exception that I'll talk about at the end, and that's that the deduction is never more than 20% of your taxable income less net capital gains. And the important thing to remember there is taxable income. It's not gross income, it's not AGI, it's taxable income, which means you're looking at your income after reducing for 401k contributions, for HSA contributions, for your itemized deductions or standard deduction, depending on what you're going to take now under the new Act. And so your taxable income may be significantly less than what you think of as the income that you report on your income tax return. So let's walk through an example of how this taxable income limitation works. Tom is a 50% partner in a restaurant. Tom's qualified business income from the partnership is $260,000. Tom and his spouse file a joint return and report $300,000 of taxable income and no capital gains. Because Tom's taxable income is less than $315,000, the only limitation that applies is the 20% of taxable income limitation. Because his deduction is the lesser of 20% of qualified business income or 20% of taxable income, in this case, his deduction would be $52,000. If his taxable income was less, if he brought it down to $200,000, now he's subject to the limit and his deduction would be $40,000. I think what I want to illustrate with this example is that if you are below the thresholds that I'm about to talk about for the other 2 limitations, this is the only limitation that matters. And so what is otherwise a very complicated deduction becomes relatively straightforward for folks that have $315,000 or less of taxable income as joint filers. So the second limitation is what's called a wage limitation. It applies to all taxpayers with taxable income in excess of $315,000 for joint filers or $157,500 for everyone else. The thresholds are indexed to a cost of living adjustment, and so they're going to change over time right along with the income tax brackets. As I discuss these thresholds in the next few slides, I'm going to refer to the $315,000 threshold for joint filers. The limit applies once you get to the full wage limit to reduce the deduction to 50% of the allocable share of W-2 wages or if it's higher, 25% of the allocable share of W-2 wages plus 2.5% of your unadjusted basis, so your original basis in tangible depreciable property. This deduction phases in over $100,000, so you become subject to deduction once you hit 315. It's fully phased in at 415. In between, via a very complicated formula, you sort of split the difference between what you would have received without the limit and what the full wage limit would have been. The effect of this wage limit is going to be to incentivize businesses that don't otherwise have W-2 wages to increase their employee wage base in order to increase this limitation and take advantage of the deduction. So to the extent that you have an independent contractor that doesn't pay W-2 wages because they're a sole proprietor on their own, there's now some incentive to combine with other businesses in order to create an employee base so that you're paying W-2 wages. The other item of note here is that unlike the original Senate bill, which only had 50% of W-2 wages, the addition of the basis rule, this 2.5% of unadjusted basis rule, pulls a lot of businesses that otherwise may not have been able to take advantage of the deduction into its scope. In particular, real estate and capital intensive firms are going to be able to look to the basis in the real property that they acquire for purposes of meeting this deduction. So let's walk through an example of the wage limit. Same example as the first, except now Tom reports qualified business income and taxable income of $450,000. Still a 50% partner in the partnership. This time around, partnership reports W-2 wages of $300,000 and has no depreciable property. Because Tom exceeds the full phase-in limit of $415,000, that's the $315,000 initial threshold plus $100,000, his deduction is going to be the least of 20% of qualified business income, 20% of taxable income, or 50% of his allocable share of W-2 wages. In this case, the wage limit is going to apply. 50% of his 50% share as a 50% partner in the wages of the partnership is going to bring his deduction, which would have otherwise been $90,000, down to $75,000. If Tom, instead of $450,000 of taxable income, had $365,000 of taxable income, only half of the wage limit would apply because he's right in the middle of the phase-in period, and so his otherwise $90,000 deduction would be reduced to $82,500. So we've discussed the first two limitations, the taxable income limitation and the wage limitation. There is a third limitation that applies only to specified service businesses, and it's an applicable percentage limitation. This limitation also phases in over the same $315,000 to $415,000 range as the wage limitation. The applicable percentage is also subject to a complicated formula, but I think the easiest way to think about it is you start at 100% at $315,000 and then reduce it by 1% for each $1,000 that you exceed, so that by the time you hit 415, you're at 0% and the deduction is phased out for folks in specified service businesses entirely. Like the wage limit, though, it means that if you are under $315,000, this limit doesn't apply to you at all. The specified service trade or businesses that this applies to includes a laundry list of folks in health, law, accounting, financial services, et cetera. And then there's a catch-all for any business, the principal asset of which is the reputation or skill of one or more of its employees. Taxpayers and service businesses are going to attempt to avoid this limit, and the IRS is likely to address those strategies via regulation. So I'm going to talk a little bit about some potential strategies that have been discussed for addressing this, but I say that with the caveat that it's highly likely that the IRS is going to come out with guidance attempting to close loopholes and attack what would otherwise be abuses of this rule. So one possibility for folks that are in a service business is to split apart revenue streams so that your service business component is held in a partnership that is separate and apart from business lines that are not subject to the specified service business. Another possibility is to combine businesses, so combine a business that is subject to the reputation or skill of its owners with one that's not, with the hope of the combined business avoiding this limitation. Or if you are, for instance, a lawyer in a law firm, perhaps finding an in-house opportunity with a real estate firm or some other business that is not subject to the limitation. Again, I think all of these are likely to be subject to further IRS guidance because the loopholes that are sitting here are just way too large right now. So one last example just to address this specified service business. Same example as number 2, except now Tom is a partner in a law firm. Or let's say Tom is Thomas Keller, and it's arguable that his business is subject to his reputation. Again, hard to say at this point. So Tom's still a 50% partner. He still has $450,000 of qualified business income and taxable income. His partnership still has $300,000 of wages. Because Tom is above the full phase-in of 415, his applicable percentage is 0, and so both his wage limit and qualified business income is reduced to 0 for purposes of the deduction, which means his deduction is 0. What if his qualified business income and taxable income was $365,000? Please submit your answers, and we will give you extra credit after the program. The real point there, I think, is that for anyone between the thresholds, the statute is so convoluted that unless you are a masochist, you are much better off either going to your tax professional or finding what is likely to be any number of calculators that allow you to do the math on what your deduction is going to be. So there are a number of issues that are still to be addressed for 199A. One is, what is a trader business for purposes of 199A? There are a number of uses of trader business in the code. It's not clear what of that analogous authority may apply. What is clear is that being an employee is not a trader business for 199A purposes, which for anyone that can quit their job as an employee and go become an independent contractor or a partner in a partnership, create some incentives to change their status if that's possible. The IRS already faces a lot of challenges addressing the distinction between employees and independent contractors, and this is only going to ratchet up that pressure. If you are in a situation where you can't be classified as other than an employee, you may think about instead becoming a partner in a partnership, because a partner in a partnership, under existing authority at least, cannot be treated as an employee of that partnership. The difficulty with those strategies is that you still need to create sufficient W-2 income to meet the W-2 wage limit. And so just quitting as an employee and becoming an independent contractor, if you're not otherwise paying W-2 wages, doesn't solve the problem. Another issue is what constitutes a specified service trader business, in particular, what constitutes reputation or skill of one or more of your employees or owners. And as I said at the top of this section, does that draw, for instance, engineers and architects right back into the rules? Finally, the reasonable compensation standard, and does that now apply to partnerships? It has not historically. Historically, what's been required is that S corporations and C corporations, for that matter, pay reasonable compensation to their officer employees or owner employees. Otherwise, there are games to be played with the dividend rates and with self-employment taxes. But now, in the partnership context, there are significant incentives under 199A to make sure that your payments are not classified as guaranteed payments. And so the question arises whether or not the reasonable compensation standard should now apply to partnerships. A number of other issues. It applies to publicly traded partnership and REIT dividends subject to the same 20% of taxable income limitation, does not reduce employment taxes, but does apply for purposes of the AMT. The one I want to focus on is the effect on tax distributions. If you're a partner in a partnership with a tax distribution provision, the changes in the corporate rate and the effect of this 199A deduction may significantly affect what your applicable tax rate is, which means that your tax provision in your partnership agreement may not in any way align with the new reality once you take into account the new rates. And so it's a good time to reassess whether your tax distribution in your partnership agreement is doing what you think it should be doing. One final note on 199A. Section 199A contains what are some, frankly, stunning additional benefits for cooperatives. There is a 20% deduction for qualified cooperative dividends that's subject to none of the limitations that I just described, but instead merely 100% of taxable income limitation, which is basically no limitation at all. In addition to that, there is a special 20% entity-level deduction that is available to agricultural and horticultural cooperatives on their gross income in excess of qualified cooperative dividends, which basically means they're non-patronage source dividends. Because of these changes, our co-op specialists have been working tremendously hard over the last 2 months with folks to address and hopefully take advantage of some of these deductions, and it's probably the most exciting, or certainly the busiest area that has resulted from this particular deduction. With that, I will hand it over to Nathan.
I'm going to talk a little bit about choice of entity implications, and I guess to jump right to the bottom line is that we think that as a general rule, this is not going, the law changes are not going to change the basic analysis that would have otherwise been done with respect to choice of entity. And that's because the rate differential between the highest individual rate and the highest corporate rates, especially when you take into account if the 199A deduction is available, it's just insufficient to make a sea change of making C corporations suddenly a more attractive option than what they were in the past. The problem with C corporations is that they are subject to double taxation, as probably everyone in the room knows. By that we mean that the income of a C corporation is taxed first at the corporate level, and then the after-tax distributed income to shareholders is taxed at the shareholder level once again. And generally that's seen as double taxation is unfavorable, but I want to stress for just a second here that whether double taxation is unfavorable is wholly dependent on what tax rates are. So if a corporate tax rate was 25% and the dividend tax rate was 25%, a C corporation that was distributing all of its after-tax income would be subject to an effective tax rate of 43.75%. That's a better deal than if it was a pass-through and you had an individual income tax, ordinary income tax rate of 50%. So you can have 2 layers of tax and still pay less tax than one layer if the one layer has a higher tax rate. That's not any crazy insight, but it's something that people don't take into account very often because of the fact that during most of our working lifetimes, for those of us who started working after, say, 1990, the tax rates really haven't been that much different in terms of the highest rates for individuals and corporations. That was not true between 1969 and 1981 and in other historical periods. And during those periods, the highest marginal rate, during 69 through 81, the highest marginal rate for individuals was 24% higher than the highest marginal corporate rate. And that led to a lot of motivation on the part of corporations to retain and reinvest income within the corporation rather than subjecting it to that higher rate. If you do the math, it meant that the effective tax rate on fully distributed corporate income could be as high as 83.8% during that time period. So for the last 25 years, that same differential, instead of being 24%, has been more like no more than 4.6%, between 35% for corporations and 39.6% for individuals. And so for that long period of time, none of us have thought very much in terms of planning with respect to retaining corporate income in the corporation, because it simply didn't do you any good. You'd have been better off to avoid having it in the corporation at all. This new act changes that. It reintroduces that motivation because of a 16% rate differential. That's enough to get people's attention. It again is wholly dependent upon whether you're going to distribute the income or not. If you can keep the income in the corporation and avoid that second layer of tax, the 16% is enough, especially over time, to make a big difference. We can see this chart's a little bit hard to see maybe because the numbers are small, but a C corporation that is able to retain 90% of its income and distribute 10% winds up subject to a current effective tax rate of 28.9%. And that is better than the rate that you'd get with a pass-through with a full 199A deduction, which comes out at about 33.6%. Now, obviously, that 90% of retained income is probably eventually subject to tax, but perhaps not. There are many operating companies that have a stated policy of retaining a very significant part of their income and reinvesting it in the business with no intent to distribute it out. And so that especially for C corporations that have an existing policy, even a long-standing policy of retaining the income, the new act is really kind of a windfall. For corporate or for entities that are beginning a new business, they probably still are subject to many of the same pressures that would have led them to want a pass-through status before the new act. They're probably going to have either losses or not very much income in their earlier years, and they're probably going to have owners that are thirsty for distributions of whatever income is there. And so this is why I said earlier that the C corporation form, the law is not transformative into making C corporations a panacea at all. But for companies that are C corporations that are already operating, the law is a great deal. So that's kind of where we are on choice of entity. The law does give some opportunities potentially for planning because of this C corporation retention of income. And I work a lot with private companies and with an estate planning focus. And so I'll talk a little bit about some things that are being discussed as things we're going to be thinking about in the future. This isn't a well-developed recommendation. This is really just things that are floating around that people have begun to discuss as things we're going to be thinking about in the private company context. First of all, especially if you have a situation where you have a senior generation owner, somebody say in their 70s, who is going to hold on to the stock till their death and is not worried about having the stock included in their estate, either because the value isn't high enough or because the estate planning they're going to do is just not going to get the stock out of their estate. They're going to have a really significant motivation, and this frankly constitutes a lot of our clients. They're going to have a significant motivation to keep money in the company and reinvest it and try to grow the value within the company and avoid that second layer of tax currently. That's really significant, especially in the context of if this person, the senior generation person, dies, under current law, the stock that they held during their lifetime, the basis in that stock will be stepped up to full fair market value at death. And if the company can be liquidated or perhaps sold in an asset sale after death, followed by liquidation of the company, the second layer of tax may be escaped forever. It may just simply never apply, which could mean that there could be a long period of time where you're able to use after-tax dollars that are a greater amount than you would have been able to use had you taken the money out of the company, and then you might not get taxed on that second layer at all. There's discussions about it doesn't make sense for people in this situation, people if the company needs capital, should an individual make fixed income investments inside of a C corporation rather than doing them individually. At the individual level, the interest income on bonds, if you were buying them, is going to be taxed at ordinary income levels. You move it into the corporation should be able to pay corporate tax rates on that interest income. Again, you've got to get it back out. If you have to get it back out, and you have to get it back out soon, this isn't a good idea. But if you can put the money in and leave it there and possibly couple it with a step up in basis at death, this could be a significant move for people to shift their individual investment portfolios, at least the fixed income portion of it, into their corporations. The last concept on here is the most sort of probably risky and quirky, but could you take things like short-term capital gain assets or collectibles, each of which are subject to higher than the normal capital gains rates, and just move them into the corporation and have the corporation do the sale if the corporation needs money, and can use it for reinvestment within the corporation after the fact? Whether the IRS will put a stop to that, it seems likely, but this is something that's being discussed in articles that are out there. I'm going to skip past the next couple of slides because we need to leave time for John and Mike. But before I do, let me just say a couple of things about the accumulated earnings tax, because that is something that is the offset to this idea of retention of capital. For the last 25 years, nobody's cared about or even heard about the accumulated earnings tax because it really hasn't applied because the corporate and individual rates were so close. But it's a tax that has the purpose of trying to prevent taxpayers from accumulating earnings in a C corporation and avoiding having them be subject to that second layer of tax. It's a pernicious tax in the sense that it is a penalty tax. It's not something you'd file on your return. It would be asserted on audit. And if it applies, if they're successful at applying it, it's a 20% tax on the accumulated earnings, and those accumulated earnings are still subject to another layer of tax when they're distributed out of the corporation. And so it's not something anybody wants. It's probably not something that's going to be a problem for operating companies who are going to retain income and then use it for things that are part of their business or even incidental to their business. But the law says that if you are using the corporation for the purpose of avoiding income tax by permitting earnings and profits to accumulate instead of being distributed, the tax applies. And if you are a mere holding or investment company, that's prima facie evidence that you have that tax avoidance purpose. So the concept of somebody saying, I have $10 million and I would like to, I'm never going to need this for the rest of my life. I'm going to put it in a C corporation, do all the investments in there, let it grow and give it to a charity at my death, is not going to work because they're going to run straight into the accumulated earnings tax.
Mike? Hi, Mike Voves. I'm here with the executive compensation update portion of our program. We'll just focus on a few sections of the code that are germane to my area and might be of interest to you. And the first one, and I think the one we'll spend the most time on, were the changes to section 162M of the code. 162M is a provision that's specific to public companies, and it provides for a limit on the amount of deductible compensation paid to certain top named executive officers. 162M has been part of the tax code since the early 1990s, and it has been it has been very integral in the sort of shaping the evolution of equity compensation, particularly in the public company realm. I would dare say it's in large part, at least, a reason for the explosion of stock options and things that fit within under certain exemptions to this limit. So, just very briefly, as the section was written prior to the recent changes, compensation paid to certain covered employees, which we'll just say are generally speaking top paid named executive officers as disclosed in company's proxy, over $1 million was not deductible. However, there was a significant exception to that limitation, and that exception was for certain types of pay that qualified as performance-based compensation. So the new tax reforms made significant changes in three respects. One, by expanding the definition of what is a publicly held corporation. Two, by expanding the group of both current and former named executive officers who are now covered by this limitation. And most significantly, number three, by eliminating the exception for performance-based pay. So let's just take those one step at a time. The first change was the expansion of the definition of publicly held corporation. Previously, as the provision was written, any issuer of securities that was required, of common equity securities that was required to be registered under Section 12. So generally speaking, that would have been a company whose shares was traded on a nationally recognized exchange, or maybe certain other companies who had a combination of having assets of a certain amount and a number of shareholders that exceeded a certain amount that triggered a requirement to be registered under Section 12. That was the only type of entity that was subject to 162M. Now, as revised, any issuer of securities that is registered under Section 12, whether it's equity securities or debt securities or whatever, is subject to 162M. And more importantly, perhaps, is any issuer that, even if your shares are not traded on a recognized exchange, as long as you have a registered offering, could be of debt securities or equity securities, that is, you filed a registration statement under Section 15 of the Securities Exchange Act, you are now picked up and covered by 162M. And I personally think that this item here, this last item I just mentioned, has been slightly overlooked in all the chatter that's going on about 162M, is that there's been a slight but significant expansion in the groups of entities that are now covered. So I think, most people had sort of gotten comfortable with the idea that, oh yeah, my shares are not traded on an exchange, so therefore I'm not covered by them, I'm not public. But you might now be surprised there are, we deal with a significant number of clients who've had certain, had to do certain registration statements for certain offerings that had to be registered. And those entities now need to be mindful of 162M. So that's item number one. Item number two, the new legislation expands the definition of covered employee. And it does so in a couple different respects. And in order to explain the first one, I need to take a slight detour back in time to explain how we ended up where we did. Remember, 162M was first added to the code in the the early 1990s. And at that time, the statutory provisions were written to sort of dovetail in with the Securities and Exchange Commission's definitions of what is a named executive officer. And that included the chief executive officer by position, and then a number of other executive officers by virtue of how much they were paid. And around 2006, the SEC changed its proxy disclosure rules to add the chief financial officer as a named executive officer by virtue of his or her position, not by virtue of how much he or she was paid. And as a result of that, it just created a disconnect between the way 162M was written, and therefore the IRS issued some sub-regulatory guidance that said, until this thing gets fixed, the CFO is not a covered employee under 162M. So if some of you have been wondering why for all of these years you've seen in proxy disclosure statements why there are these statements saying that the CEO and the next three highest paid named executive officers other than the CFO are covered under 162M, that's why, because of this glitch. So the new legislation fixed the glitch and added the CFO, not surprising, but it did much more. Previously, again, the way the statute had been written and the way the IRS interpreted the language and sub-regulatory guidance was that in order to be a covered employee, you had to be in that position on the last day of a given taxable year for which you were intending to take a deduction. And so we could make arrangements to pay large amounts of severance or large amounts of deferred compensation to certain retiring or terminating executive officers. And as long as we didn't make the mistake of having them resign on the last day of the year, all of that compensation would be exempt from the $1 million deduction limit. Well, now, not surprisingly, the new rule is essentially that once you're a covered employee, always a covered employee. So if you are in a covered employee position and you move into a non-officer role, you're still a covered employee. If If you move, if you retire in the middle of the year and we're still paying you out severance and deferred compensation, guess what? You're still a covered employee, and this compensation is still subject to these limits. So great expansion in terms of the groups of people that are covered. All right, and now for the big one, the most impactful change under 162M, which was essentially the removal of the exception for performance-based compensation. Now, for those of you that work in this area or live in this area, you probably know that 162M performance-based pay is as much about a process as it is about what is it, right? So in order to have performance-based compensation, you had to have, number one, compensation that was established, approved, and certified by a committee that was composed of outside directors. You had to have the committee act and establish objectively determinable performance goals within a certain period of time, generally within 90 days of the beginning of the performance period. You had to have the committee make sure that its discretion was limited, so it could not retain positive discretion to increase the compensation payable upon the achievement of these objective performance goals. There was an ability to retain negative discretion to reduce the amounts, but positive discretion was bad. So there were all these things. And all of these things were tied to ensuring that whatever you paid was in fact performance-based compensation. All of that is really history now. There is no longer a tax-driven reason to follow this process. Certainly, we can expect that as part of good governance, companies, or public companies at least, are still going to have and use performance-based compensation. And they're still going to use metrics that that many institutional shareholders approve of, things like total shareholder return and whatnot. I can expect those will still be popular, but the process by which they do it no longer needs to follow what essentially was a 162M driven process. And so what else do we expect to see? Well, many of you may know that we used sometimes, and I'll just say this freely, we used gimmicks, we used tricks as a way to get around these 162M limitations. And the most significant one was where companies wanted to be able to exercise discretion to increase pay up or down. We would create so-called plans within plans. In other words, we would create programs that nominally awarded every named executive officer a percentage of the company's earnings or profits. And since profits are not guaranteed, even if you have a history of profitability, that alone was treated as performance-based pay. But the compensation committee would reserve discretion to ratchet it down, and then they would apply sub-metrics to that, which were essentially the real performance plan. And it was all these things that we would do to try to help the company reserve as much discretion as possible, but still make sure the compensation was fully deductible. None of that is necessary. We don't have to go through that process. So companies should feel free to re-examine what they're doing. And then the other thing that I think we really should talk about, but unfortunately I can't give you a lot of definitive guidance, is that there is a transition rule that applies to arrangements, or I should say written binding contracts, that were already in effect as of November 2nd, 2017. And there's a lot of chatter in terms of the scope and breadth of this transition rule. I mean, in its simplest form, you can imagine a stock award that was issued in 2016 that by its terms was performance-based pay, and as long as you don't touch it, let's say it vests and matures and pays out in 2019, that should be grandfathered. That's sort of a simple example of a grandfathered arrangement. But what's not clear is, what if you have an executive that has an employment agreement, and in that employment agreement, which was adopted, executed prior to November 2017, and what if that employment agreement provides that the executive is entitled to participate in the company's bonus programs and deferred compensation programs? And what if it goes so far as to name the specific program and to name the specific levels of bonus or performance that the executive participates at? 50% of base salary for minimum, 100% for target, or whatever. Are these legally binding agreements that could grandfather future bonuses that are paid out? I don't have the answer to that question, but this is what we're kind of seeing. We're seeing people speculate as how far can we take this transition rule. And so all I can say is at this point in time, be leery about amending your existing plans and programs to strip out 162M provisions just yet. You may want to think about whether or not there may be an opportunity to avail yourself of the transition rule, and we'll try to keep you posted as the best we can. All right, so that was 162M. Section 83I. Was talking with another lawyer about this, who described this as essentially a big nothing. And I think I'm inclined to agree. And to set the stage a little bit, Section 83I is limited to private companies, okay? Only private companies. And why that is if you work with private companies that are sort of pre-IPO, pre at some point where there's liquidity, you often run into situations where employees receive, more often than not, stock options. The employees, for good reason, have to leave the company. Maybe it's nothing to do with poor performance, but maybe for whatever reason, they've invested a lot of time and sweat and energy into building up this company, to bringing it toward a place where they can perhaps achieve an IPO, and then the employee leaves, and generally only has a limited period of time to exercise that stock option, more often than not 90 days. And because of the way tax laws are structured, there is, the companies and employees have a limited ability to extend the life of that option if the option is in the money, as we say. So what 83I attempts to do is provide employees with a very limited deferral opportunity to defer the gain from, or at least, to defer income from either a stock option or a restricted stock unit that would otherwise become payable upon the exercise of the option or the maturity of the restricted stock unit. And, this provision, like I said, it's already limited because it's only available to private companies, but hopefully the context helps you understand why that is, because employees often are in a situation where there's no liquidity, or they don't have the ability to come up with the strike price. So this is a way to allow employees some ability to defer income to a future time. The problem is that if you look at this next slide here, there is an 80% participation requirement. Well, first I should say, CEOs, CFOs, and many highly compensated officers aren't eligible to take advantage of this, okay? So that takes away a big group of people who might be interested in this. Number two, it's only available to corporations that have written equity plans that allow at least 80% of all employees in the corporation to receive stock options and RSUs with the same rights and privileges. And I think, and I've read this again to see, well, is it just that, the plan has to allow anyone to participate, or do they actually have to receive awards? And I'm pretty sure it's the latter. So that right there, I think, is what makes this a big nothing, because I don't know of many clients that have plans that have broad-based stock option plans or broad-based restricted stock unit plans that go this far. I would say, some of our clients have employee stock purchase plans that are tax-favored stock purchase plans. You get a little bit of an opportunity to buy stock at a discount. Those are inherently broad-based plans. They must be in order to meet certain tax qualification rules. Those might fit within this type of program. But again, I just don't quite see the utility of deferring the gain from those types of programs. So that, in a nutshell, is 83I, and it only deserves that much time, I think. Okay, very quickly, trying to stay on pace for John here. Last topic for me, Section 4960. And this is something that's a little new to me because it's specific to tax-exempt entities, and frankly, I don't work a lot with tax-exempt entities. However, the provision itself borrows from several provisions in the tax code that I am quite familiar with, namely 162M, which we already talked about, and Section 280G. And what new Section 4960 does, it says essentially that certain tax-exempt organizations are required to pay an excise tax on certain excess remuneration paid to covered employees. The first type of excess remuneration is compensation that exceeds $1 million for any given taxable year. That should sound familiar because that is essentially inspired by and based on 162M. Also, and this operates independently from the $1 million limit, there's an excise tax on any excess parachute payments that are contingent upon an individual's separation from service. And again, that's not tied to $1 million. It's actually what it is tied to is tied to a multiple of your historical earnings. So if it exceeds 3 times your average wages, you trigger an excise tax. That may also sound familiar to some of you. That is essentially taken from 280G. Except the difference here is that whereas under 162M, what you're dealing with is a loss of a deduction. And under section 280G, what you're dealing with is a loss of a deduction as well as an excise tax imposed upon the employee. Here, we're dealing with an excise tax that's imposed upon the entity. And what it's intended to do is deal with the fact that, you have certain tax-exempt entities that are very large, have highly paid executives, and it's trying to put them on the same playing field as publicly traded companies. It is kind of curious, though, that, private companies, although nominally subject to 280G, generally can get around it by going through a cleansing vote. Private companies are not subject to 162M, so this is, in some way, kind of putting public companies and large tax-exempt entities in one category, and then putting private companies in another category. So, that is interesting. There are also some, I'll quickly wrap up here, there are also some interesting facets about this provision, I think, that are worth exploring, because if you read any of the news headlines about it, essentially you'll probably see it described as, so this is like the Nick Saban rule. This is saying that because the University of Alabama pays Nick Saban 11 or 13 or whatever they pay him, $1 million a year, that this is covering that situation. If you actually look carefully at the way the statute is written, it provides that it applies to entities that are exempt from tax under 501A. It provides that entities that are political organizations are exempt, as well as certain exempt farmers cooperatives. And then finally, any entity that has income excluded from taxation under section 115 per N1. Now, I'm no expert in this area, but there is, I think, some confusion as to whether a state university, whether that's what state, I don't know that that's in fact the operating provision that keeps them from being exempt from tax. And so it may be that there is no excise tax on the $10 or $11 million that is paid to Nick Saban at the University of Alabama, but there might be on the income that's paid, say, to the coach at Northwestern. There's I think some further analysis that needs to be done. Last thing, promise, John. Last thing. What's not here? Most importantly, in the early iterations of the different forms of legislation that were bouncing around, there was an outright repeal of 409A and essentially an elimination of deferred compensation, non-qualified deferred compensation altogether. That didn't survive, so deferred compensation is still alive and well. And there were also some proposed limits on catch-up contributions to 401k plans that were also never went into effect. So that's it. That's the executive comp update.
Now for the exciting stuff, the international bit. You can tell by looking at Ben, Nathan, and I that this tax act is having tremendous adverse impacts on tax lawyers. I mean, since it's passed, the three of us started losing our hair. The hair we have left has turned gray, and we spend so much time at the office worrying about these rules that when we wake up in the morning, we don't have the energy to shave anymore. So Mike's doing a lot better than we are, but
I just shaved. Bob knows.
Yeah. But if you think that the rules we covered so far are complex, the international rules are really complex. To try to be able to give you an understanding of this at a high level, I can't do it at the 10,000 foot level in the time we have. I'm gonna have to do it at the 100 foot level, but I'm hoping to give you some idea how these rules work. And to make it simpler, many of these rules apply to 10% or greater U.S. shareholders of foreign corporations, but I'm mainly gonna deal with parent companies with 100% owned subsidiaries just to let the conversation flow better. So the major objectives of the international tax changes are to encourage U.S. companies to repatriate funds back to the United States. Apple's announced that they're going to repatriate most of their $252 billion in offshore funds back to the U.S., invest some of that in the U.S., and create 20,000 new jobs. Cisco's recently announced they're going to bring $67 billion back, although they're going to use a lot of it for share buybacks instead of hiring new people, unfortunately. And, you know, secondly, to make America more competitive. I remember sitting in a meeting with an Irish law firm, and they were telling me that one of their big practice areas was forming new Irish holding companies for U.S. private equity firms that were buying U.S. technology to avoid the U.S. 35% tax. So hopefully now that the tax rate's down to 21%, we won't see that happening as much. And as Ben mentioned earlier, you know, Intel announced that taxes is going to be a neutral factor in deciding whether to build new facilities in the U.S. or offshore. And then also, as we'll see, one objective was to reduce the number of inversions that have been happening. Okay. So we have basically a new approach to international tax planning with the U.S. rate dropping from 35% down to 21%. You know, many U.S. and foreign companies with U.S. subsidiaries structured their affairs to minimize their U.S. taxable income because we had one of the highest rates in the world. And give you a good example, Microsoft over the last 5 years had 50% of their sales in the U.S., but only 18% of their profit was in the U.S. So they were shifting 32% of their profit offshore. And the Seattle Times had an article saying that Microsoft saved $27 billion in taxes by doing this and waiting until the U.S. rate came down. So many companies will need to look at their cross-border structures, reevaluate whether those still work under the new tax environment, look at their transfer pricing arrangements, see if they want to rejigger those to move more profits into the U.S. rather than offshore. And the issue of whether to form a new venture offshore in the U.S. is a closer call now than it used to be. Okay. The first major change is a one-time tax on accumulated offshore earnings. So this relates to pre-2018 earnings, and it's estimated that there's $2 to $3 trillion of offshore earnings that U.S. companies have that they haven't brought back to the United States. And so, you know, and this was because we had a 35% rate. So if a company made money offshore and brought it back to the U.S., they'd have to pay tax at 35% rate less foreign tax credit for the foreign tax. And, you know, I always compared it, I do a lot of Canadian-related work, and I always compared the Canadian system to our system. And Canadian system was go out in the world, make as much money as possible, bring it back to Canada, we're not going to tax you again, and invest it in Canada. And the U.S. system was go out and make as much money as you can in the world, bring it back, and we're going to tax you at 35%. So it was completely different systems. And so the incentive was for U.S. companies to make money offshore and just keep it there and not bring it back because of the high tax bill. So the way this one-time tax on offshore earnings work is to the extent the earnings are represented by foreign cash and liquid assets, there's a 15.5% rate, and the balance of the earnings are taxed at 8%. Companies have 8 years to pay the tax without interest, and then these earnings can be brought back to the United States tax-free. Okay. To give you an idea of how our new system works, this diagram reflects the prior system, and in the dark gray box on the left, you have subpart F income, and subpart F income is basically passive income such as interest, dividends, passive royalties, etc., and then also income that had no economic connection to the country in which the controlled foreign subsidiary was formed. And that income was immediately included in tax on a current basis at the U.S. parent level and subject to the 35% tax less a foreign tax credit. So companies would structure their affairs to avoid subpart F tax. Then there was everything else, and everything else was deferred and not subject to U.S. tax until it was brought back to the United States, and then it was subject to a 35% tax, less the foreign tax credit. So the whole U.S. system was built for U.S. companies to keep their earnings offshore and not bring it back because the tax bill was so great to do so. The next slide is intended to give you an idea how the new system works. We still have the dark gray box for subpart F income, except when subpart F income is included at the U.S. parent level, it's subject to a 21% tax now, not a 35% tax, and there is a foreign tax credit available. And then the rest of the income is divided into two boxes. There's the low tax income and the high tax income, and basically it's broken down at 13.125%. if the tax rate is in the foreign countries, and I'm generalizing, there's a lot of complicated calculations, but basically if the foreign country's taxing the controlled foreign corporation at 13.125% or higher, it's in the high tax category. If it's below 13.125%, it's in the low tax category. And the low tax category is going to be subject to what's called the GILTI tax, but there's going to be a tax on income that's subject to low tax. No tax on income that's subject to the higher tax. Okay. And it's a fairly low rate, 13.125. Okay, I'm gonna skip that one. Okay, so as I mentioned, on the low tax income, there's something called the Global Intangible Low Taxed Income, or GILTI tax, and it imposes a minimum tax on shareholders of CFCs. And the computation is very complex, but basically you compute the intangible income in the foreign country, in the foreign subsidiary, and the way this works is very kind of weird, I'd say, but they compute a base tangible income amount at 10% of your amount invested in tangible assets, and everything else is deemed to be intangible. So basically, if you're looking at an Irish holding company with IP, all the income is going to be intangible. So if the rate is below 13.125%, then under this GILTI tax, there's going to be assessed a U.S. tax at the differential between 13.125 and the actual tax assessed. So I've got a very simple example on the next page. So you have a U.S. parent corporation owns 100% of a Canadian corporation and 100% of an Irish corporation. And the Canadian corporation pays a royalty to the Irish corporation for the use of intellectual property. The Canadian corporation pays a 26% tax on its business income. It's not subject to the GILTI tax because its rate's above the 13.125%. The Irish corporation pays a 6% tax in Ireland on its royalty income, so it's subject to a GILTI tax of 7.125%, the differential between the 13.125 and the 6%. Okay. So it's a dramatically different system now. If a U.S. company's earning money offshore and paying 13.125% or greater, it can bring it back tax-free. If it's paying less than 13.125 in the foreign country, then there's this GILTI tax to bump it up to 13.125. Okay. Then we now have a foreign source dividends received deduction, which many people call the participation exemption. But it allows U.S. corporations that own at least 10% of the foreign corporation to take 100% deduction for dividends received from the foreign subsidiary. So now, once you've paid your GILTI tax and your subpart F tax, et cetera, you can bring back the actual dividends and not pay an additional tax. So it's completely different than the old system. Okay. And there's a 1-year holding period requirement, and there's no foreign tax credit for any foreign taxes with respect to those actual dividends. The next slide is a simple example. This you have a U.S. parent corporation with a Canadian subsidiary, which has a Canadian business. The U.S. parent receives a dividend from the Canadian corporation. It receives the deduction equal to 100% of the dividend, so it pays no tax on the dividend. And although there'll be a 5% Canadian withholding tax on that dividend, and there won't be a foreign tax credit for that. So there'll be a foreign tax cost for bringing the money home as a dividend, but not a U.S. tax cost for doing that. Okay, the next item is foreign derived intangible income. Many people refer to this as FODI. You know, tax lawyers love acronyms, but this is basically this is basically an incentive for exports, and it allows a deduction on certain foreign derived income that brings the effective rate on that income down from 21% to 13.125%. And it's to encourage American exports, and it's to make the decision whether to build U.S. plants or foreign plants neutral. So this FODI and GILTI taxes are supposed to make offshore U.S. operations neutral, although the calculations when you get into them don't make them exactly the same. Okay. So the next item is the BEAT, the base erosion and anti-abuse tax. This only applies to extremely large companies with $500 million average gross receipts over the preceding 3 years and a base erosion percentage of 3% or more. And basically, you take your regular income tax, taxable income, add back in these base erosion payments. And these are payments such as interest, royalties, and similar things that are paid by U.S. corporation to a related party and reducing the U.S. tax base, so they're called base erosion payments. You add back the base erosion payments, come up with a modified taxable income, apply the beat rate, which starts out at 5%, goes up to 12.5% in future years, and that's your corporate alternative minimum tax under this rule. The next slide, I've got a list of payments that are included and not included, but the big thing is cost of goods sold are not included as a base erosion payment. So manufacturers have an advantage on these rules over service providers and financial institutions, and service type companies should consider changing their global service contracts so they don't have all the income coming to the U.S. parent, and the U.S. parent makes payments to the foreign subsidiaries. Should have the payments go directly to the foreign subsidiaries to avoid application of the B tax. Okay. Got a simple example of the B tax on the next slide. U.S. parent corporation with a Canadian subsidiary and a U.S. subsidiary. The U.S. subsidiary purchases product and makes royalty payments to the Canadian subsidiary. The royalty payment is a base erosion payment, but the payment for the cost of goods sold is not. Okay, credit agreements. So as we discussed now with that participation exemption, actual dividends paid by a foreign subsidiary up to the U.S. parent doesn't attract any additional tax. But the Section 956 rules are kept in place. And these are rules where if a controlled foreign corporation subsidiary provides direct or indirect credit support to a U.S. parent, there's a deemed dividend up to the U.S. parent because there's an argument there's been value transferred by the subsidiary to the parent by supporting loans to the U.S. parent. And so you have a situation here where a deemed dividend is taxable at 21% under the 956 rules, but an actual dividend is not. So this is a real trap for the unwary. I was really, when I started reading about the participation exemption and there'd be no tax on actual dividends, I was really surprised that this was kept in. Okay, I'm running out of time here, so I'll go a little quicker. In cross-border structures, there's a lot of what's called double dip structures where there'd be a deduction in the United States, mainly interest, but the receipt of that payment in the foreign country would not be income, it'd be tax-free. So it's called a hybrid payment. It's deductible for U.S. purposes, but not included in income for foreign purposes. And those are called double dip structures frequently. And basically, deductions, hybrid payment deductions are denied 100% now, and payments to hybrid entities are denied now. Okay. Another rule that I think is going to trap a lot of people is when a foreign partner in a U.S., well, it could be in any partnership, U.S. or foreign, that operates a U.S. business, when the foreign partner disposes of their partnership interest, they're now taxable in the U.S. for on their gain. And the IRS has wanted this rule in place for a while. They tried to do it administratively. The court struck it down, but now Congress has enacted it. And to make matters worse, the buyer has to withhold 10% of the purchase price and pay it over to the IRS. And if the buyer doesn't withhold the purchase price, withhold the 10% paid over to the IRS, then the partnership has to withhold that amount from future distributions to the buyer and pay it over to the IRS. And so you can end up with some unusual circumstances like this one here. You've got a Canadian partnership with a U.S. business, and you've got a U.S. seller and a U.S. buyer. And if the U.S. buyer doesn't obtain a certificate from the U.S. seller that the seller is a U.S. person, not a foreign person, then technically the U.S. buyer is going to be subject to this withholding tax responsibility. And if the U.S. buyer doesn't pay the withholding tax, then the Canadian partnership has to withhold. So you can end up with some weird situations here. in the FERPTA area, the real estate transfer area, there's all kinds of exceptions and certificates and things you can get to avoid the withholding tax. For instance, if the foreign seller doesn't have a gain, they're in a loss position, you can get a certificate and you don't have, the buyer doesn't have to withhold, things like that. We're hoping that at some point the IRS will give us similar rules to the FERPTA exception rules, but as of now, if you're a buyer of a partnership interest, you better get some kind of certificate that the seller is not foreign, otherwise you have this withholding responsibility. And then the partnership's gonna need to get evidence that the partners, the buyer and the seller complied with these rules. Okay, and the last item is, there's a number of provisions that make inversions less attractive. And so I think we're gonna see less inversions in the future. And thank you very much.
I think that's the end of our time. Thank you, everyone.